I got a few messages asking me why gold has done nothing on the prospect of World War III when Trump bombed the Fordo and Natanz and Bushehr nuclear, whatever they are, in Iran. Who knows what's there? When that was bombed and they used a B-2 bomber to make giant holes in the ground, people thought that maybe World War III was starting. I didn't think so. I was not very happy about America's involvement, but I'm very happy that it's not going any further. I said that World War III is not going to start. I don't think it's going to start, but why didn't gold react? Well, we can see in the history of gold's reactions to wars. You can see here that March 20th, 2023, you can see this line. This is when Bush 2 invaded Iraq. Gold did pretty much nothing. It was in a downtrend. The invasion of Iraq did not affect it much at all. You can see here gold did little on October 7th, 2023, when the Middle East war between Israel and Hamas broke out, which is now spread to between Israel and Iran. We'll see if that's over for now, but you can see on October 7th, or October 7th was a Saturday or a Sunday, whatever it was a weekend. And it was a Saturday actually, so the first trading day after October 7th, gold went up a little bit, but it wasn't really recognizable as anything related to a war here. You can see this size candle also was over here and over here, and this was just regular action for gold. This is my proprietary chart. You'll probably only see it on the Endgame Investor. I talk about it a lot on Substack. Subscribe there, link in the description below. The blue line is the ratio of repos that take place every night between banks and the amount of reserves, bank reserves available that these repos are getting funded with. So you see the black line. This little spike over here is the repocalypse of 2019 when the Fed had to begin the QE round that extended through COVID and up to here, I think, was when the QE finally stopped. And now as it is stopped, we see this ratio going higher and higher and higher again, which means that the amount of bank reserves that are taken up by repo trading keeps going higher and higher. And this is the repocalypse line. We haven't crossed it yet on the week average, but we're getting really, really close. And this is going to keep trending higher as the bank reserves run out. So we should get there in the next few weeks finally, and then we're going to see what happens then. It's going to be just to get into the specifics of this. Where do I get 80%? Well, there are $2.74 trillion being traded in the repo market every night. As of June 23rd, you can see the number here, $2.74 trillion. The amount of bank reserves available is $3.406 trillion. This number is a little bit inflated because the Treasury cannot raise money from bank reserves to raise its cash balance because there is a debt ceiling that is still in place, and that has to be raised. That has to be raised, and once it's raised, they're going to take more money from the bank reserves, and this number is going to shrink, while this number, the 2.74 trillion, is going to rise, and we're going to hit some kind of wall.
Behind the scenes of nightly banking operations, a critical ratio is quietly approaching a tipping point. The volume of repurchase agreements repos is climbing sharply relative to available bank reserves. This imbalance echoes the 2019 liquidity crisis that triggered emergency Federal Reserve action. With reserves dwindling and demand surging, the financial system may soon confront a pressure point unseen since the last monetary shock. The U.S. Treasury's cash buffer is rapidly shrinking. Post-tax day inflows offered brief relief, but current levels now sit near 2023's debt ceiling lows. When reserves vanish, market intervention is inevitable. Gold remains steady in a healthy consolidation phase, but silver, still undervalued, is poised to benefit most. If historic patterns hold, silver's resurgence could sharply narrow the gold to silver ratio in the months ahead.
That's coming in the next few weeks, guaranteed. I don't know how many weeks, but it's weeks, not months. 366 billion to go. This is the Treasury's cash balance of $366.52 billion. You can see here that this little blip up was the rise in the Treasury's cash balance after tax day, which was April 15th, 2025. They have pretty much spent their entire blip up in the cash balance, and they're back now at 383 billion on the weekly, but now it's below that, 366 billion. So here was the last debt ceiling raise. We were about 50 billion here. Here was the one before that. So you can see here the time from here to here is shorter than the time from here to the next debt ceiling raise, which is going to be as this blue line falls to zero. And believe me, it's coming soon. And once it does, we're going to see some monetary fireworks. And that is what's going to propel gold and silver, especially silver, as I think that ratio, the gold to silver ratio, is going to fall not immediately to 15-1, but somewhere, I think it's around 95. It's going to head to 85, 75, maybe 65. I think that's where it was in 2021. Silver is still the play to make here. What is happening with gold? It seems to not have been doing so well over the past few weeks. It's in a consolidation. It's completely normal. The uptrend line since the beginning of the year. This is the year-to-date trend line from 2025. You can see the black line here. It was touched a few times in April and once in May, and it's not been touched again. I think it's getting close. I think this is a day or two behind this chart, but I think the 50-day moving average is 33.15. We're above that now. I think it's about 33.40, but the trend line is somewhere around 3,300 or something like that. We have not gotten there yet. We could touch it again. I don't expect this trend line to break, or if it breaks, it will only break very briefly. Gold is still moving higher, trending higher. I wouldn't worry about it. This slide is brought to you by Kootenay Silver, which I own, symbol KOYF in the US, symbol KTN in Canada. You can see here on a chart of Kootenay, which is in the candles. These candles over here, I've overlaid it with the silver price. You can see that the price of Kootenay moves up and down more or less with the silver price. So as silver moves higher in dollar terms, so will Kootenay Silver on a more leveraged basis because it's a junior miner, junior explorer. If you are interested in junior explorers, then Kootenay, I believe, is a decent pick, at least for myself. You have to do your own research. I don't recommend anything. The basic logic here is that Kootenay just came out with a maiden resource estimate, which is the first step towards developing a mine for eventual takeover by a bigger silver miner. Next step they have to do is a preliminary economic assessment, which will be within the next 12 months, and then we'll see if they can get a bite by a bigger mining company, and that will benefit shareholders very well. And obviously, as silver heads higher, so will Kootenay. So if you're interested in explorers, then Kootenay is worth looking into, let's say. Let's talk about gold and war.
Contrary to headlines, gold isn't a first responder to war. History shows minimal price movement during conflict onset from Iraq in 2003 to Israel-Iran tensions in 2025. Instead, monetary consequences after war like inflation and credit stress fuel gold's rally. Oil market, however, tell a different story. June 13th saw record trading volumes amid fears of supply disruption, highlighting market sensitivity to geopolitical flashpoints. A silent tremor is building in the platinum market. For a non-active month, June 2025 saw a record number of deliveries, a rare event historically linked to strain. With low inventory and fragile supply chains, platinum may be the first domino to fall before stress hits gold or silver. While speculative, early positioning in platinum may offer a hedge against broader delivery instability.
I got a few messages asking me why gold has done nothing on the prospect of World War III when Trump bombed the Fordo and Natanz and Bushehr nuclear, whatever they are, in Iran. Who knows what's there? When that was bombed and they used a B-2 bomber to make giant holes in the ground, people thought that maybe World War III was starting. I didn't think so. I was not very happy about America's involvement, but I'm very happy that it's not going any further. I said that World War III is not going to start. I don't think it's going to start, but why didn't gold react? Well, we can see in the history of gold's reactions to wars. You can see here that March 20th, 2023, you can see this line. This is when Bush 2 invaded Iraq. Gold did pretty much nothing. It was in a downtrend. The invasion of Iraq did not affect it much at all. You can see here gold did little on October 7th, 2023, when the Middle East war between Israel and Hamas broke out, which is now spread to between Israel and Iran. We'll see if that's over for now, but you can see on October 7th, or October 7th was a Saturday or a Sunday, whatever it was a weekend. And it was a Saturday actually. So the first trading day after October 7th, gold went up a little bit, but it wasn't really recognizable as anything related to a war here. You can see this size candle also was over here and over here. And this was just regular action for gold. It looked like we were in some kind of a intermediate cycle low here. So coming off of intermediate cycle lows, you should expect strong action in the price. And I don't think this had anything to do with October 7th itself or the prospect of war in the Middle East. So gold does not react very well to war. What it does react to is credit events and monetary developments, which usually take place after a war is finished and all the inflation that took place during the war has to be dealt with. That's when gold and silver start to move a lot higher. Remember that the gold to silver ratio went to 15-1 in 1919, which is after World War I. And the inflation post-Civil War happened in 1865, which was after the war between the states or the Civil War, whatever you want to call it. And all in all, so far, this war between Israel and Iran cost America very little. What's going to cost it a lot more is the big, beautiful bill that now has to be passed. Near record oil trading volume on June 13th. One thing that the war between Israel and Iran did affect was oil trading, not in terms of price, but in terms of volume. You can see here that oil did go up a little bit, but then it came back down. You can see this long candle here, and it was pinned at around 77, I think was the high, something like that. And then it went back down below 75 that same day. But you can see here there was something special about that day on June 13th when Israel attacked Iran. You can see here that the trading volume was above 3 million contracts for the day. Now, in context, that is an enormous number. We're going to see that the exact number of contracts traded on that day, this is from the CME website, was 3.608676 million. So 3,608,676 contracts. You can see that was highlighted on this bar over here. Now, where does that fit into the rest of oil trading history? You can see here, I put the line of the volume over here where that circle is. And the last time that this line was broken, only twice was it broken, meaning this is the third highest daily trading volume for oil contracts in a day ever. The biggest day for oil trading was the day that oil went down to negative $35 a barrel in the wake of the COVID lockdowns. You can see here that the Russian invasion of Ukraine did not do much for the volume. It had a little bit of a spike, that's true, a little bit above 2 million contracts on that day. So there was a spike, but it was nothing compared to here what happened. What happened, I believe, was that there was a binary situation. Either Iran would have blocked the Straits of Hormuz, which would have blocked 20% of the oil, of the world's oil traveling through that strait every day, which would have brought oil up to maybe $150, $200. Who the hell knows? I don't know. I'm not an oil expert, but it would have been very bullish for the oil price. Or the Iranians wouldn't do anything, and perhaps their regime would fall, and then it would become Western friendly, and then you'd have to take off all the sanctions, and the Iranian oil would go through the market, through the global markets, and that would be very bearish for the oil price. We saw that Trump did put out a post on Truth Social that the Chinese can now buy oil from the Iranians. It was a carrot and stick approach. So this is bearish for the oil price. And we can see that oil went back down to the mid 60s. The downtrend line for oil is still intact. You can see that downtrend line since 2022 over here on the Russian invasion. It's still continuing down, and we're now back down to the 60s, though it was tagged on the Israeli attack on Iran. It did not break. The downtrend line is still intact. The last subject in this silver report, let's talk about little silver. That is platinum. This here is the 2020 platinum deliveries. You can see here, this was an all-time record, October 2020, 5,753 deliveries. But the point of this is to show you that outside of the active contracts, Really, the whole situation changed here on the lockdowns, April, May, June 2020. And here we had a huge spike in platinum deliveries, 4,131, then 5,753, which is the all-time record. But outside of these active contracts, very few platinum deliveries, only eight, right? 75, very, very little. We can see in 2021 a similar pattern. The bottom here, you have 2,074 deliveries, 3,122, 3,579, and 2,676. So these are still very high numbers compared to the pre-COVID days. But the point is, in these inter contracts that are not active, only a few hundred deliveries. Now, what is happening now is something very different that we're on June 24th towards the end of this month. And this is an inactive month. We have 1,167 platinum deliveries for an inactive month. That is an all-time record. We are seeing similar things in the inactive gold and silver contracts this year since the gold and silver rallies began earlier in 2025. So we could end up with some problems in platinum deliveries. We'll see. We have seen the record gold deliveries that were a few months ago, 76,000, came immediately after record deliveries for the non-active contract in the month before. I've always had a suspicion that problems in the deliveries in the precious metals would begin with platinum or palladium just because the supply there is so low compared to gold and silver. The supplies in COMEX for gold and silver are both very, very high, not so much for platinum or palladium. So before we have a gold or silver default, we could have a platinum or palladium default. Right now, the candidate looks to be platinum. That is where the price is moving. So if you want a little bit of platinum, I don't think it's such a bad idea, but I wouldn't load up on this stuff because it is very volatile. In any case,